Hey warriors, I hope you're all doing great. So yes, the September 2025 examinations are finally done. I'm sure all of you have put in a lot of efforts to get through these examinations, and now that it's done, you're already feeling very happy. Personally, from my side, I'm feeling very happy that your exams are done because I know every one of you would have taken so much amount of struggle to go through this exam. It's definitely not an easy joke to go through an exam, especially at a CA level. Me being a student in the past, I can also relate to it, and I know how much difficulty it takes for a person to be calm at the same time composed so that you can write your exams properly. But hey, it's already done, and I'm very proud of all of you to have gone through these examinations. In today's video, as usual, what we're going to do is we're going to quickly review the September 2025 paper for your paper number 3 income tax related topics so that you and I can both understand how the paper looked like. Yes, on a preliminary level, a lot of students did tell me that the paper was quite manageable. I wouldn't say it was completely easy, but definitely quite manageable. If a person has done the subject reading properly, then they should have been able to answer this paper enough. But yeah, as a faculty, let me also go through this paper along with you and discuss with you as to how the paper looked like, and then we can decide on how much marks you have been scoring for your examinations. Now, before I take you forward to this paper, there are a couple of things which I would like to warn you as much as I do it in every other review paper as well. Point number one. If you're a September student who has written this examination, please look at this video purely for educational purposes. The intention of this video is only to discuss about how the level of paper was and where and all could you have gone wrong, or where and all probably I say tried to take you and you did not realize it. Yes, this review video is with no intention to come and ask you to grade your marks and then start deciding or start worrying about the fact whether you will clear or not. Trust me, the paper is already done. At this stage, you and I can both not decide how much marks you're going to get. It is all in the hands of an examiner, and therefore you have to trust the process at this stage of time. Do not start coming and asking for too many additional questions to me on my videos. Unnecessarily putting in a comment saying that Rahul, in question number 1, I did this much. I should have done this much. Maybe there is a small mistake. How much marks do you think I will get? I have no idea. I do not want to give you any comments on how many marks you will get because trust me, I am not correcting your paper. Even if I tell you will get 5 on 5, examiner can end up giving you even 1, can end up giving you complete 5 also. Yes, so I do not want to come at this stage and discuss with you on how much marks you're scoring. It's all about just realizing how your performance has been. You can on a high level itself decide whether your performance has been good and you should be continuing with your enjoyment of your exam leaves, or yes, no, I have not done up to my standards and therefore I should probably take an early picture to decide on my Jan 26 is what we are going to discuss in this video. Nothing more, nothing less. Point number 2. For all my Jan 2026 students, yes, this paper is completely relevant to you. Yes, there is nothing which is changing from this paper to your paper. So please take this opportunity to write this Jan 2026 paper as an test. I would probably put it that way. Yes, consider this as a mock paper and write it for your exams and see how you are performing, and then use this video for deciding on how your answers are looking like. Yes, so Jan 2026 students should actually look at this video very seriously after you have done the test on your side. That is what the intention should be. Are we making sense? Yes, perfect. Now without wasting any further time, let's quickly go into the video and let's understand how every question looked like from an exam perspective. As usual, we're going to start from the MCQ perspective first. So yes, I'm looking at case scenario number 1. As a standard practice, I've always told you in exams people, case study is not the first question to answer, but nevertheless, since it's a review, let's go it in the same sequence. I'm going to be ignoring the case scenario and I'm going to directly be looking at the question for me to first understand what exactly is happening in the questions. Question number 1. It says, assuming all incomes of Sudipto and Shanu is 55 lakhs and 11 lakhs respectively, which of the following statements is correct? So we have some guy called Sudipto, we have some woman called Shanu, and they are now deciding as to who is going to be taxable for how much. Looks like a clubbing of income question to me. Let's see what is happening. Second, which of the following statements is correct as far as clubbing of salary is concerned? Yes, they have already discussed about clubbing provisions once again. Question number 3. What shall be the amount of deduction available under section 80D in hands of Sudipto, assuming he has opted out of default tax regime? Yes, so 80D provision, chapter 6A question has been requested for 3 questions in your book. Let's understand what your case study looks like. Case study number 1. It says, Sudipto is a resident individual aged 54 years and has gifted a shares of an Indian company listed on a recognized stock exchange in India to his friend Shanu to help him financially on 1st April 2024. So there is a guy called Sudipto. Sudipto has given it to Shanu. Okay, great. The gift deed states that the shares will be transferred back to Sudipto in the death of Mr. Shanu, which means this has now become an irrevocable transfer. Yes, for those who remember this carefully, people, we have discussed this in classes multiple times. When it comes to clubbing provisions can only happen when it is a revocable transfer. The fact that it's going to be done after the death of Shanu means this is an irrevocable transfer, and therefore clubbing provisions will not apply. Sorry. The fair market value of the shares on the date of transfer is given as 54 lakhs. Shanu received a gross dividend of 4 lakh 50 during the year. So the fair market value has been decided to you. They've given you the gross dividend. Now the fact is very simple, because it's an irrevocable transfer. There is no clubbing rules to apply. So this 4 lakh 50,000 should be taxable in the hands of Mr. Receiver. Who is the receiver? Shanu is the receiver. So this is going to be taxable in the hands of Mr. Shanu. That is what we're going to agree upon. But I want you to understand this carefully. The transfer is happening to a friend. Yes, the fact that it is happening to a friend means that I'm so sorry. The fact that it's happening to a friend means that it is not going to be covered under any exceptions to the gift taxability, and therefore 56.210 should come into picture, which means Shanu is going to be taxable for the FMV of the shares. So in the hands of Shanu is now going to be paid tax on two items. One is on the dividend of 4 lakh 50. Second is on the IFOS income of 54 lakhs. Let's see what part of the question has been requested for. Assuming other incomes of Sudipto and Shanu is 55 and 11 lakhs, which of the following statements is correct? Case number 1. Dividend income will be taxable in the hands of Shanu as clubbing provisions will not apply. Yes, prima facie this looks right. I would agree to this statement. Dividend income shall be clubbed in the hands of Sudipto. No, definitely not happening. Dividend income shall be taxable in the hands of Sudipto. Again, not happening. Dividend income is exempt from tax. No such rule, people, which means you are safer here. They've not even asked you on the gift taxability. They've asked you only on the clubbing rules. Clubbing rules, point number A, makes the answer for you. Yes, fairly, very easy question, people. I would say easy 2 marks for you in your exams. Next. Second part of the question says, Sudipto is engaged in the business of retail trade as a proprietor. During the financial year 21-22, he has paid 25,000 per month to his wife Swati as a salary, being the marketing in charge. Okay, so there is a woman called Swati. Swati is her wife, and she's been engaged in the same office as a marketing in charge. Swati does not have any professional qualifications. Very good. So which means the woman is not having any professional qualifications or experience for the job. Clubbing rules are going to start attracting to you. This income was clubbed in the hands of Sudipto as per clubbing rules in financial year 21-22. Notice it is not in the current financial year, it is happening in 21-22. Swati started her MBA studies and did not get any salary from 22 to 24. She completed her MBA marketing on 1st December 24 and again joined her husband's business, now starting to get a salary of 55,000 per month as salary, which is as per market norms. Which means they have confirmed that now she is professionally qualified in the current year and she is getting salary as per the market norms. That is what the fact pattern is. Let's look at what the options are. Which of the following is correct as far as the clubbing provisions will apply? Salary of Swati will be taxed in her hands as now she has the required qualification of the job. Yes, prima facie, I would say this looks like the right answer. Salary of Swati will continue to be clubbed in the hands of Sudipto till the assessing officer is satisfied. Very good. This is where they are trapped you. Yes, a trapping related thing, people. This is something which you have been trapped upon. Yes, now we'll have to discuss upon this, but let's look at the other two options also just to be clear if they are matching. Third, salary of Swati will be taxed in the hands of Sudipto or Swati whose income before is higher. No, this is for a minor child, not for husband and wife. As part of tax planning, Swati has the option to decide in whose hands the salary will be taxable. No, this is not going to be the answer, which means now you have to decide between A and B. Yes, now prima facie, I know everyone who would have written this exam would have chosen the answer as option A. Personally, if you come and ask me, I would also agree to answer as option A. Unfortunately, the answer is going to be option B. Yes, the hint is given in the MCQ, people. If you notice, the MCQ comes and says that Swati was never professionally qualified for this salary and therefore in the past in 21-22 she was getting clubbing rules applicable. Yes, now unfortunately clubbing rules section 64 has a specific proviso. The specific proviso basically comes and says that when a clubbing rule is already applied in the past, in the subsequent years also the clubbing rule will continue to apply unless the assessing officer is satisfied. Which means in this case, even though Swati has now become professionally qualified, she will have to go and prove it to the assessing officer that yes, I am now professionally qualified and therefore I do not want clubbing rules to apply in my own name. That is unfortunately what the answer should be, and therefore it is option number B. Now, Rahul, what happens to option number A? Can you say option number A is right? Honestly, if you come and ask me as a practical person, I would say option A is also right. Because let's be very honest, if your clubbing rules have applied in the past, that is because you have voluntarily made that decision. In the subsequent years, do you think at any point of time you will go to your assessing officer and ask him for a permission on these kind of things? No. As a person, you are never going to do that, people, which means the moment she is professionally qualified, especially after the fact that she's taken a gap and she has come back, you will automatically come and say that this is a new employment and therefore you would say option A is right. Honestly, as an inter student, I don't expect you to have that much kind of a practical knowledge on these kind of scenarios. So yes, ICI should ideally be giving you answers for both. Yes, ICI should honestly give you marks for both people, which means ICI should technically give you marks for option A or option B. That is what my simple request is going to be to ICI. Theoretically, yes, option B is the right answer, but in all practical sense, option A should be the right answer. So I think the answer should be option A or option B. ICI should definitely consider this alternatives and give answers to both of them. Yes, unfortunately, if not, then you are going to lose 2 marks here. Nevertheless, let's look at point number 3. Point number 3 says, during the previous year 24-25, Sudipto has paid 54,000 as medical insurance premium by way of account paycheck for his senior citizen parents, but the problem is they are non-residents. Yes, here is where the next challenge comes. Now, I remember telling this in exam in classes multiple times. Please note the fact that a senior citizenship status only holds validity as long as you are a resident person of India. Which means the moment you are not a resident of India, you can never be called as a senior citizen from Indian norms. In Indian norms, if you are a non-resident, you are always going to be a normal category person. Why is that impactful, people? Because in section 80D, we say that when you are a resident senior citizen, you get 50,000 worth of benefits. But the moment you become a non-resident, you are only eligible for the minimum 25,000 worth of limits, which means I cannot claim the whole 54,000. I will only be end up claiming 25,000 as a deduction. Yes, so 25,000 is the right answer. Nil and all is definitely not an answer, people. Unfortunately, this student did not end up doing it well, but nevertheless, yes. So 25,000 should be the right answer. That is what you should be getting your marks upon. Yes. Now, if you have noticed the non-residents, ideally you should have written this properly, and therefore 25,000 should have been the right answer. If not, unfortunately, yes, lack of preparation is what is being disclosed here. Nevertheless, so 3 questions for you. In these 3 questions, I think question number A was fairly very easy and simpler. Question number B, yes, is a choice which ICI has to make. Question number C, I would say you should have managed to do it properly. So question number 3 should have been given you 2 marks, which means 4 marks is what you should have easily scored in this MCQ, other being subject to conditions. Yes, perfect. Let's look at case scenario number 2. Case scenario number 2 gives me options. Let's look at the options. It says, which of the following statements is correct as far as the taxability of the house property is concerned? So they're asking a HP question. Assuming Shubh pays arrears of rent to Reenu on 28th June 2024, what shall be the treatment of such rent if she has to pay 5,000 from her collection? Unrealized rent question. And then finally, question number 6, which of the following statement is correct as far as the taxability of buyback is concerned? Cost inflation indexes are given to you. Yes, I remember telling you this so many times, people, in your focus topics as a video. You always should be focusing on amendments, and I told you so many times in that video that buyback dividend is going to be part of the exams, especially also because of the fact that it was tested for finals at May batch, which means it was expected for inter at September, and see what has happened. Yes, you've got a buyback dividend question. I really hope you all would have done the right answer here, but let's check what the right answer is also before I give you the final conclusions. Yes, so let's look at the case study question. What does the case study come and say? Reenu is a resident individual aged 48 years, owning 2 flats A and B in Hyderabad. She lives in flat A and gave flat B to her in-laws for a residential purposes. So I have a flat A and a flat B. Flat A she is living, flat B her in-laws are living, which means both are SOP properties. She does not charge any rent from them, good enough for her. In the month of April 2024, she entered into an agreement to buy flat C from a buyer in the same area as her other flats are situated, which means now she has proposed to buy the 3rd flat. In the month of September 2024, she took possession of flat C and started spending her weekends there after paying a token amount of 11,000 to the builder. However, flat C is still not registered in her name. So they have decided that it is still not registered in her name. All 3 flats are identical in size and aspects, which means now they have come and confirmed saying that 3rd flat is not her ownership, 2 flats are in her ownership. Here is where they have tricked you. 99% people, students would have come and said, yeah, 2 flats is what is in my ownership and 2 flats are SOP, which means nothing is taxable. Unfortunately, no. For those who have read the syllabus properly, you would have known there is a section called section 27. Section 27, which talks about deemed ownership concept, comes and clarifies that if I am a person who has paid some advance and has taken possession of the property, in that case, I will also be considered as the owner of that property, which I'm anyway going to get in the subsequent future. Yes, so that is what deemed ownership concept says, which means even now, the moment she paid an advance money, she became the owner of the 3rd property as well. And therefore, unfortunately, she now has 3 SOPs. With she having 3 SOPs, she can only declare 2 SOPs as her nil income, and the 3rd has to become a DLOP. That is what the right answer should be. So let's check. 1 flat of her choice will be treated as SOP, whereas the other 2 flats will be treated as deemed let out. Yes, the first option itself looks right, and the student has also done it right. So great job. Any two flats will be treated as SOP, whereas a third flat will be treated as deemed let out. Oh, no. I'm so sorry. Option A is definitely wrong. Oh, I didn't read it properly. It says one flat of her choice will be treated as SOP, whereas other two flats will be DLOP. That can never happen, people. You can never have two flats to be DLOP. You can only have two SOPs and one DLOP. So option A is wrong. Any two flats of her choice will be treated as SOP, whereas the third flat will be treated as DLOP. Yes, this is what the right answer is. Next, flat A will be treated as SOP, flat B will be treated as deemed let out, and flat C will not have any impact as the flat is not yet registered. This is where they tricked you. Yes, ideally most of the students should have treated option C as the right answer, but unfortunately it is option number B. Next, all three flats will be treated as SOP. That would be a violation of condition. You cannot have three flats as SOP. Yes, next. Sorry. She had one more flat D which is let out at a monthly rent of 45,000 to Mr. Shubh during the financial year 21-22. So during financial year 21-22 is when I had a flat which I had let out for a rent of 45,000 rupees. Shubh did not pay the rent for 3 months. Reena sold the flat on 31st March 2024, which means this flat is not there in her ownership in the current year. She owned 5,000 shares. Oh, I'm sorry. So what has happened? Assuming Shubh pays the arrears of rent to Mrs. Reenu on 28 June 24. So which means there are 3 months of rent she is going to receive right now. If I have to calculate this, I have received a rent of 45,000 per month into 3 months. That gives me 1,35,000. Yes, so 1,35,000 worth of rent is what I'm going to receive after paying an expense of 5,000. Now, for those who understand the provisions of unrealized rent carefully, the provisions of unrealized rent come and say that even if you are not the owner of the property, it will be taxable in the year in which you receive it, and no expenses can be allowed as deduction against this rent except for a 30% flat deduction, which means 1,35,000 minus 30% flat deduction gives me 94,500 rupees. That becomes the right answer. Yes, so nothing shall be taxable as she is not the owner. No. 1,30,000 will be taxable. No. 94,500 will be taxable. Yes. Option number C looks like the right answer. 89,500 after claiming the 5,000 is not possible. You cannot claim any such expenses. You have already been given 30% flat deductions off. Yes, I think this was a fairly easy question, people. Nothing complicated about this. Next, she owned 5,000 shares of PQR Limited listed on a recognized stock exchange, Indian company, acquired on 22 for 180 per share. The company bought 2,000 shares from her and paid 420 per share to Reenu. Buyback dividend rules, people, and it has happened after 1st October, which means it is applicable as per the new laws. New laws come and say that whatever is your consideration value that you receive, that will become fully as a buyback dividend. So how much consideration did I receive? The company has bought back 2,000 shares at a price of 420 rupees, which means 8,40,000 is going to become my buyback income. Let's check what the answer looks like. I have PQR shall be liable for 1,95,000 as additional income tax. No. 8,40,000 will be treated as deemed dividend in the hands of Reenu. Yes, this is the right answer. 4,80,000 will be treated as long-term capital gains. No, no LTCG is happening. 4,80,000 will be deemed dividend. No, nothing of that is happening, people. 8,40,000 becomes my complete deemed dividend in the current thing. If you have done the buyback dividend properly, this would have given you a free 2 marks for your examinations. Yes. Amazing. I think from here starts your individual MCQs. So we're looking at individual MCQs. It says AP and Sons HUF is controlled by Amarendra. Okay, the Karta of an HUF. Amarendra, an Indian citizen, stays in country T, regularly visits India, which means the person is an Indian citizen staying outside India and is visiting India. During the financial year, he visited for 190 days and managed the affairs of HUF. People, the moment the guy has come for 190 days, I don't even have to worry about any condition. He is automatically a resident in India. Yes, the fact that he is managing the affairs of the HUF also from India means HUF is also having control in India, and therefore HUF also becomes a resident, which means here my conclusion is going to be that Mr. Amarendra is a resident and the HUF is also a resident. Yes, next, during the immediately preceding previous years, 5 years, he has visited India for 70 days each, which means in all the years totally he has gone there for 350 days. Apart from that, he was there in India for 185 days prior to that, which means, people, income tax comes and says for the last 7 years you should have satisfied less than 730 days to be an RNOR. Let's check. 350 has come for 5 years plus another 185 days for year number 6, 185 for year number 7. Totally stay in India has become 720, which is less than 730 days. The moment it became less than 730 days, I am an RNOR. Yes, with Amarendra becoming an RNOR, HUF automatically becomes an RNOR as well. Yes, HUF automatically becomes an RNOR as well, and therefore the answer should be that Amarendra is an RNOR, HUF is also RNOR. The residential status of AP and HUF has been requested for you. Non-resident because Karta is a non-resident. No. Let me change my colors. Yes, no. Resident and ordinary resident, no. Non-resident because control and management is partly, no. Resident because control and management of its affairs is partly managed from India. Not ordinary resident because the status of the Karta is resident but not ordinary resident. Yes, option number D is the right answer on this. Yes, this was also a manageable easy question. 1 mark for your examinations. Question number 8. I think this is the last question. Yes. It says Ravi is an Indian resident, brought an overseas tour package from Karthik. TCS LRS rules, people, which I told you will come for examinations in the current attempt. Check this out. Has an overseas tour package, also a resident Indian and seller of overseas tour package, has paid 7 lakhs as cost. People, current year amendment comes and clarifies that the moment you have made money for overseas tour package, for the first 7 lakhs you will be liable for 5%, after which you will be liable for 20%. I've made a payment only up to 7 lakhs, which means I'm going to be liable for 7 lakhs at the rate of 5%, which is going to become 35,000. Yes, he has also remitted 12 lakhs to USA for LRS scheme for the purpose of investment in USA share market via Jones, a resident authorized dealer. I have now made some alternate payments as well. LRS rules come and says that when you're not making a payment for overseas tour package, for the first 7 lakhs, it's not going to be liable for TCS, and for the balance, I'm going to be liable for 20% TCS, which means in the 12 lakh rupees, I'm going to eliminate the 7 lakh rupees and I'm going to tax the balance 5 lakhs at the rate of 20%. 20% ends up becoming 1 lakh rupee, which means my total is going to become 1,35,000. Yes, what shall be the aggregate amount of TCS? Answer is 1,35,000. Option number A is the right answer. Yes, so A is going to become my right answer. That is what the most logical answer is. You should not be getting option number D as the right answer. I'm not sure why D is the right answer here. Yes, amazing. This is the mark of MCQs, people, after which starts section number B, which I'm not discussing. So let's quickly check how much you would have scored if you have done everything properly. You have question number 1, fairly easy one. You should have definitely scored a 2 marks here. Question number 2 is where I'm playing a game. So I'm assuming 2 marks should have scored to you. 4 here. 6, yes, this was an easy one. You should have definitely scored a good mark here. So 6. Yes, this is where I feel a little bit of a trick, people. So maybe you would have gone wrong here. So I'm leaving a mark here. Maybe 2 marks is not deserving here. You have 2 here. Definitely, yes. Unrealized rent was an easy question. So therefore an 8. Buyback dividend should have been very easy for you, people. So 10. AP and Sons, yes, this was an easy question. So therefore 11. And then here comes your LRS, which is 13. So 13 out of 15 is easily scoreable. If you have been able to answer that, I'm sorry, which question was it? Yes, the deemed ownership question, then you should have scored the whole 15 on 15 also. I think MCQs, yes, this time was fairly manageable. There was just one question, which is question number 2, which I feel unfortunately should not have been tested at inter level, but nevertheless, let's hope that ICA gives you an alternative marks on this. This is your review of MCQs. Are we clear till here? Amazing. Let's quickly do a review of what is happening on the question paper as well. I'm going to do it a quick review, people. I'm not going to be solving things unless it is absolutely required. So let's look at it only from a review perspective. Let's see how this looks like. We are at question number 1. Yes, I'm looking at your compulsory question, the 15 mark question, PGBP, obviously, as always, people. Let's look at the question very carefully. Question number 1 says, Mr. Ram is a resident individual aged 58 years and is engaged in the manufacturing of textiles. I say manufacturer, which means I know he is eligible for additional depreciation. The statement of profit and loss has reported to you a net profit after depreciation but before tax. After depreciation but before tax of 52 lakhs for the financial year ended 31st March 25 after debiting and crediting the following items. So 52 lakhs is going to become your starting point. Before I proceed forward and start to understand as to what are the adjustments, let's quickly check on what exactly is the requirement of the question. You are required to compute the total income and tax liability of Ram under both regimes. Oh wow, under both regimes, normal as well as 115 BAC, and suggest which one is more beneficial. Ram is preparing on mercantile basis accounting. Cost inflation indexes are given to you. Yes, this is going to be a little lengthy one, people, because they're going to ask you for both the regimes. What I'll do is I'll look at every adjustment and I'll clarify to you if I should be doing something on original under normal provisions, should I be doing something under 115 BAC. First adjustment for me. Adjustment number 1 says depreciation as per income tax rules is 28 lakhs, including additional depreciation on new plant and machinery of 1,50,000. Now, unfortunately, this is something which I assume students would have ended up making a mistake upon. Yes, most of the times what happens is students look at depreciation as per income tax rules and normally come and say, Rahul, yeah, it's an income tax rule depreciation, therefore I should allow as reduction, therefore they end up minusing it. Here is where you would have made a mistake. Notice this carefully. It says after debiting and crediting the following items, which means adjustment number 1 is already part of my P&L. Yes, understand this carefully. It says debiting and crediting the following items, and it says point number one is depreciation as per income tax rules, which means point number one is already part of your P&L. When it is already part of P&L and it is already as per income tax rules, there is no reason for me to make an additional claim. The fact that if I do an additional claim will give me a double deduction, which would become illegal. Yes, so which means under old tax regime, I would simply ignore this information of. I cannot do any adjustment for this because everything has been done appropriately. The only thing which will happen is if I am under DTR, the default tax regime, I am going to add back my additional depreciation of 1.5 lakhs, because you all would be aware when it comes to new tax regime, you can't claim the additional depreciation. Yes, a very, very tricky adjustment, people, which I hope you would have done properly enough if you have read the following lines carefully. Point number two. Interest amounting to 2,10,000 for short payment of advance tax as per 234B has been relating to assessment day 24-25. This brings you to section 48.2. 48.2 basically comes and clarifies any tax related payments of income tax will be fully disallowed, including interest and late filing fees and stuff, which means this is now going to get disallowed. So I have to disallow the whole 2.1 lakhs, both under old tax regime and under new tax regime. Yes, amazing. Third one. 3,50,000 was paid to contractor for carrying out whitewash work at the factory premises. Tax was not deducted at source on this payment and the contractor did not file his return of income. People, the moment you see TDS obligation, you only have to ask a simple question. Is he a resident or a non-resident? I see this person is a resident, which means I'm going to disallow 30% of this number as a flat disallowance. So I have 3,50,000 multiplied by 30% gives me 1,05,000 to be disallowed under old tax regime and to be disallowed under new tax regime. Yes, no changes here. I think this was a fairly easy adjustment. Next. Contribution to Prime Minister National Relief Fund has been paid by check. Again, people, if you notice, it says after debiting and crediting, which means this item is already there in my P&L. So I would have to disallow this from my P&L of in PGBP statement. So I will disallow this as 3 lakh rupees, both under old tax regime and new tax regime. But because this is a payment to Prime Minister National Relief Fund, I am eligible to claim 100% of this as a deduction under section 80G under the old tax regime. Yes, so after you compute a gross total income, you can end up claiming the 3 lakhs as a flat deduction under 80G. It's a Prime Minister National Relief Fund, category number A, 100% deduction granted to you. Point number 5. Expenditure towards advertising charges in a brochure of political party has been paid by way of check. Again, check has been given, people. This is not relating to my business. I disallow this under my PGBP statement. So 40,000 gets disallowed under both the regimes. But at the same time, because this is payment to a political party, I can claim this under 80GGB and GGC for my old tax regime, which means old tax regime is technically going to ignore this, but yes, steps are very important. So disallow it under PGBP, take it as deduction under chapter 6A. Next, interest on term loans obtained from a cooperative bank but not paid before the due date of return filing. The moment I see not paid before the due date of return filing, provisions of section 43B will apply, and therefore this gets disallowed in the current year. So 2.6 lakhs again disallowed for both the regimes. Next, contribution towards pension scheme. See, this is something which I remember telling you during your focus topics also, people. Pension scheme had an amendment in the current year and therefore you should have disallowed this properly as per 14% criteria rules. It says contribution towards pension scheme of the employees is 1,50,000. The eligible salary has been paid as 10 lakh rupees. Now, people, this is what I remember telling you. When it comes to PGBP, it does not matter what regime you choose. You will be eligible for 14% worth of deduction because you've paid 1,50,000, which is 15%. I'm going to disallow the 10,000 rupees off. So 10,000 rupees worth of disallowance would be made for you. Now, ideally, you should have not made this mistake, but I do notice that sometimes students end up making this mistake. They don't realize the fact that this is an NPS contribution for the employees. It is not your NPS contribution, and therefore no deduction under 80CCD will be granted to you. 80CCD deduction is only for the employees, not for you. So please be mindful about this fact. Do not end up claiming this deduction. If you have, then unfortunate mistake for you from the outset. Yes. Next, Industrial Power Tariff Commission of 2,50,000 received from central government. Now, this is something which I remember telling you during your PGBP, people. The charging section, the last point itself, I've told you so many times. Whenever you get a government grant, you will ask yourself a simple question. Is the government grant relating to an asset? If it is relating to an asset, I will reduce it from the cost of the asset. This one is showing as part of my P&L, and therefore I would simply ignore this information. I don't have any obligations on not reporting this income. It is already there in my P&L. I will consider to be part of P&L. Next, Interest from banks on fixed deposits, gross number is 1,50,000, part of IFOS. So remove it from my PGBP statement on both the sides and add it to my IFOS statement on both the sides. No changes here. No changes here. Let me check if this person is a senior citizen, because that can make an impact. No, it's 58 years people. 58 years means he is not eligible for 80 TTB. He is only eligible for 80 TTA. Therefore, I will not be able to claim the FD as a deduction. I will not be able to claim the FD as a deduction. Not a problem at all. Cash gift from father 90,000 rupees. Again, notice cash gift from father is point number 10, which means it is also part of my P&L. Should it be part of P&L? No, it should not have been part of P&L, and therefore this also gets reduced from my PGBP statement on both the sides. At the same time, because this is a gift from the father, it is an exempt provision under IFOS. Yes, it is an exempt provision under IFOS. That is what the rules would be. Yes, easy adjustment, nothing great. Next, additional information. Now, people, when it comes to additional information, the fact is normally that if nothing is given, then it is assumed it is not part of P&L. So let's keep that in mind. It says expenditure pertaining to previous financial year was allowed on due basis, but paid in the current financial year in cash, which is 35,000. Cash payment, not of the current year. It is cash payment of the prior years. People, you would have already claimed this as an expense in the prior year, and therefore in the current year you will have to report this as an income. It is not part of my P&L, should be part of my P&L, and therefore I will add this up as my P&L income. I will add this up as my P&L income. This is section 48 3A. Next, audit fees for the previous year 23-24 is 75,000. Deduction of TDS but not deposited in the relevant previous year, however done as deposit on 31st December 24. Notice that in the last year I would have not deposited this within the due date of 31st October. Because I've deposited on 31st December, it means last year I would have made a disallowance of this. Because it was a disallowance in the last year, current year I can claim this as a deduction. There is only one catch point here. This is an audit fees, which means the payment would have been made to a resident. In that scenario, you would have not disallowed the whole 75,000 in the last year. You would have only disallowed 75,000 into 30% in the last year, which is 22,500. Which means in the current year, you should have claimed a deduction only of rupees 22,500 under both the regimes. Under both the regimes, this is what should have happened. Yes, this is what the fact pattern is, people, because based on which you need to create your income and P&L statement. Yes, as such, if you come and ask me, this was not a very complex question from a total income perspective. A person should have been easily able to manage this question off. Should have not been a challenge. I wonder why they've given the cost inflation indexes to you. Have they given any capital gains related rules in the question? 52 lakhs, depreciation, interest, 3,50,000, PM funds. Yeah, I don't see why there is cost inflation index given to you. I guess they're trying to confuse you on this. Yes, cost inflation indexes have nothing to do with this whole question, people. This was purely given to you for confusing you. So you should have not considered this information at any point of time itself. Yes, I hope you have not made the mistake there. Now, question number 1, if you come and ask me, honestly speaking, lengthy question, people, definitely lengthy, because you have to do multiple adjustments in both the cases plus computation of tax. So should have been a last question which you should have answered off. But nevertheless, I think this was still a manageable question. If you come and ask me, I think keeping the dates in mind, keeping the numbers in mind, I assume audit fees could have probably gone wrong from your side. You would have made a mistake of not taking 30%, but rather taking 100%. So that is a mistake which you would have done. The cash payment is something which I assume everyone would have done. Whether you call it a disallowance or you call it as an income, the answer remains the same. It does not really matter. So I assume you would have done this properly. No issues there. Industrial power tariff, pension, yes, everything else looks easy for me. The only thing which you probably could have made a mistake is the point number 1, the depreciation part, which means if you come and ask me as a examiner, if you have done everything right, I would have ended up giving you at least 12 marks out of 15 here. Yes, a 12 out of 15 is an easily scoreable thing had you completed the question, no doubts about it. Yes, so yes, easy question for me. Good. Let's look at question number 2. Something which I always tell students to attempt the first thing. First thing to be attended in exam is question number 2, because that's one of the most easiest questions to be attended off. Let's see question number 2. It says, this is question number 2. I always ask students to attend question number 4, which is the clubbing questions. Question number 2 is the second priority question. Yes, question number 2. Shweta is a citizen of India. Okay, I have an Indian citizen coming up here. Is a chartered accountant, professional person. She is working partner in Shweta and Varun Associates, which was set up in Chennai, India. She visits foreign country quite often and provides accounting services to corporates there in an individual capacity. She's working separately as well. In country A, she is not subject to any income tax, which means in that country there is no subject to income tax laws. Deemed residency might become a concept. The details of her income for the current year is given to you. The remuneration from a CA firm, amount received in India. People, when they say it's received in India, it is always taxable, which means this is going to be fully taxable no matter what. Yes, so I'm going to treat this as a taxable component. No questions to be asked here. Sorry, give me one sec. Yes, to be treated as fully taxable. Clear? Amazing. Income received from providing accounting services in country A, received in bank account in country A, can only become taxable in India if she's an ROR. If even if she's RNOR, it is not going to be taxable. As of now, I'm going to put this on hold. I don't know what is going to happen. Dividend income from country incorporated in country A and received in a bank account in country A. Dividend from a company incorporated in country A, received in bank account in country, again only taxable if you're an ROR. So let's look at this facts again. Income from a country in business in country A, which was set up in country A but is controlled from India. You see something which is controlled from India, which means this is now going to become taxable in India provided it is an RNOR. So if it is an RNOR, I'm going to tax this fully. If it is an NR, I'm going to ignore this income off. Ascertain a residential status, briefly explaining the relevant provisions along with the taxability of the income in the following independent scenarios. She did not visit India during the financial year 24-25. People, in the current year, the woman has not even made a single day visit, which means she would have become a non-resident. But if she is a non-resident also, I will now have to check for deemed residency conditions. Because the person is a citizen of India, I will have to check for the deemed residency condition where my Indian income should become more than 15 lakhs. How is my Indian income becoming more than 15 lakhs? I should be checking all incomes as if I am an RNOR. Yes, so let's check all incomes as if I am an RNOR. Remuneration from her CA firm in India, which is going to be given to her. Details of her income. She is working, so which means this is a deductible while computing income of the firm. Is she a partner? Yeah, she's a partner, people. Apo, this is taxable as PGBP income. Yes. Now, why am I looking at this? Because it is taxable as PGBP income, there is no concept of giving standard deduction to you. Otherwise, I would have ended up giving a 75,000 rupees standard deduction under new regime and 50,000 standard deduction under old regime. Because this is PGBP, this becomes fully taxable in India. Yes, so 16 lakh becomes fully taxable, and this itself gives me the fact that the Indian income is more than 15 lakhs. With the Indian income becoming more than 15 lakhs, she is not making any visit in India, not liable to tax in any other country. She is going to become an deemed resident or an RNOR. Yes, I'm going to treat her as a deemed resident and an RNOR. I hope everyone has made this as deemed residency with RNOR and has not made the mistake of calling it an NR. An NR would have been a horrible mistake. Yes, she's an Indian citizen having an Indian income more than 15 lakhs. She is an RNOR because the Indian income is, she's not taxable in that country. Next, she visits and stays in India for 200 days every year since the 12 preceding previous years. She is coming to India for 200 days worth of visits every year. If she is going to be an Indian citizen visiting India, her Indian income being more than 15 lakhs, she has to be in India for 120 days or more and 365 days in the last 4 years. 200 days means more than 120 in the current year. Last 365 becomes easily satisfied because it becomes 400 in just 2 years. It just becomes 400 in 2 years, which means again she is going to become an RNOR. Next, she did not visit India during the previous year 24-25 and her income from profession in India is 4 lakhs for the financial year instead of 16 lakhs. See, this is where the catch point is. Because the income is now going to become 4 lakhs, I am now looking at this income being 4 lakhs and this income being 7 lakhs, totally becoming only 11 lakhs. With the total income becoming 11 lakhs, it becoming less than 15 lakhs, the person will become an NR. The person will become an NR. This is what the fact pattern is. Ascertain the residential status and the taxability of income. So income is also tested for you people. In the first scenario, I was an RNOR, right? Yes, because I was an RNOR, my income is taxable. This would not be taxable. This would not be taxable. So it becomes 16 plus 7, which is 23 lakhs. Yes, so I'm going to be taxable for 23 lakhs in the first scenario. Same 23 lakhs is going to be taxable in the second scenario. In the third scenario, I'm a non-resident. As a non-resident, this becomes a challenge. Because I'm a non-resident, 4 also does not become taxable. Point number 1, I have itself confirmed that the 16 is now going to become 4 lakhs, which means I'm only going to be taxable for 4 lakhs in this. This is going to be my income statements. 23 for the first one, 23 for the second one, and third one for the 4 lakhs. I think fairly manageable question, people. Maybe a little tricky for you to realize it at an initial stage, but definitely a manageable question. Should have been able to score it really well. Question number B. Looking at TDS related question. Aryan is a resident individual engaged in retail trade of auto parts through various sources across Delhi NCR and has had total turnover of 15 crores during the financial year 23-24. Last year I have a turnover of 15 crores, more than 10 crores. Following data is furnished to you. He has purchased goods worth for 105 lakhs excluding GST at the rate of 18% on 21st May 2024 from Diva LLP, a limited liability partnership resident in India. Out of these purchases, goods worth 5 lakhs excluding GST were returned on July 2024 due to quality issues for which Diva LLP refunded the money on 20th February 25. Assume that the turnover of Diva LLP during the financial year 23-24 was 8 crores. Question says, what does the question want from you? Discuss the TDS and TCS implications in the above, assuming transactions of all PAN numbers have been given to you. Yeah, so this is where they've tricked you a little bit, people. First, rule number 1, the moment you have made an initial purchase, you are liable to deduct a TDS. More than 50 lakhs makes you liable for 0.1% TDS. I've done a transaction of 105 may say if I remove 50, answer becomes 55. 55.1% gives me 0.055 lakhs. Yes, so in transaction number 1, I am going to be liable for a TDS of 0.055 lakhs. This is what is going to be my TDS in the transaction number 1. The catch point comes in transaction number 2. It notices, it says the 5 lakh rupees has been refunded back. Now, when you refunded back the 5 lakh rupees, technically you should have also refunded back the TDS. Unfortunately, that's not a scenario in a practical situation. In a practical situation, when you have a refund happening of a goods, you cannot be adjusted in the prior cases. You can only adjust it in the subsequent payments, which means in the subsequent payment, when you make the person, you can go and tell him that, you know what, I'm going to pay more to you at that point of time because at some stage I have to refund back the TDS to you. Yes, which means, is there going to be any impact on the TDS of the 105 lakhs? Answer is no. This transaction of 5 lakhs is not material for the current financial year, would be taken as consideration for the next financial year. That is what the fact pattern is going to be. Yes, unfortunately, people, this is something which should have not been tested at inter level, should have been tested only at final level, because you need practical insights on it. To know the fact that you cannot adjust it with the previous transaction but have to adjust it with the future transaction is the final level topic. Should have not been tested at inter level, but unfortunate enough. Next, Aryan has paid 77,000 per month to Mr. Kulveer, a resident individual, for providing catering services in his shop under a contract. Now, people, have provided catering services under a contract, and this is happening in his shop, which means this is going to be a business transaction. A business transaction happening more than 30,000 rupees on a single day payment will be making you liable for a TDS at the rate of 1%. So, I'm going to be liable for TDS of 770 rupees under section 194C. Under section 194C. I think this was very easy. You should have been able to easily manage this off. Yes, I think, yes, point number 1, you could have made a probable mistake. You should have not scored the whole complete 2 marks, but nevertheless, they should have at least given you 1 mark on that. Point number 2 was fairly damn easy, people. You should have easily scored a 2 marks on this. Good. Yes, let's move on forward to the last 2 questions. We're looking at question number 3. Question number 3 says, Mr. Money is a resident individual aged 45 years and has acquired a plot of land in March 2002. I remember telling you this so many times in the focus topics that immobile property capital gains is a must for the current year examination. Last time it came as an MCQ, this time it would come as a descriptive, and this is what has happened. Check. I have land purchase of 12,25,000 in 2002, paid stamp duty charges of 1 lakh on the date of registry. Registry stamp duty charges will be added to the cost of acquisition. Because this property was purchased after 2001, I will take the cost of acquisition as it is. He has sold his land on 10th October 24 for 80 lakhs, 10th October 24, which means it is after 23rd July. I will not be liable for any indexation rules. The stamp duty on the date of the property is 83 lakh 50,000. I will have to check for 110% consideration. Let's check 80 lakhs. So I have in my calculator 8 lakhs, 80 lakhs into 110%. Answer becomes 88 lakhs. Because it becomes 88 lakhs, I am within 110% of consideration, which means I will ignore the stamp duty value. I don't care about the stamp duty value. I'm directly focusing on the full value of consideration. Advise Money about which option of computation of capital gains is more suitable for him as far as his tax liability is concerned, on the assumption that he has no other income chargeable to tax and he has opted out of section 115BAC. Cost inflation indexes are given to you. People, this one is a little bit tricky question, because here they have not just asked you for the capital gains, they've also asked you for the tax liability. So you'll have to work this out very carefully. Let me show you what is going to happen. I'm going to break this into 2 categories. One is what we are going to call as per the new rules, yes, which is after 23rd July, and one is what we're going to call as per the old rules. Let's put out the full value of consideration. My full value of consideration is going to become 80 lakhs in both the scenarios. Yes, I have not been given any transfer expenses, which means this also becomes my net consideration. I have to take my cost of acquisition. So let me take my cost of acquisition for my new tax regime. My new tax rules come and say my cost of acquisition will become 13,25,000. 13,25,000. Whereas in my old regime, I will be eligible for cost inflation indexes. Let me check on what my cost inflation index is. I have made this purchase in 2002. Yes, now understand this carefully. They have made this purchase in March 2002. March 2002 means financial year 2001 and 2. It is not financial year 2002 and 3. Yes, that is going to become financial year 2001 and 2, which means I'm going to take the cost inflation indexes as 100. So I'm going to take this transaction as 363 into 100. So let me take it that way. 13,25,000 into 363 divided by 100 is my answer, which means it becomes 48 lakhs 9,750. Yes, can you give me my capital gains, people, quickly? My capital gains becomes 31,90,250 on the right side and 80 lakhs minus 13,25,000 is going to be 66,75,000. Yes. Now, one thing you should need to understand, people, carefully enough is that because the transaction is happening after 23rd July, my total income is never going to change. My total income is always going to be 66,75,000. Now, what if my new old rules come and give me a better tax rate? It doesn't matter. Your income is still going to continue to be 66,75,000. I'm only doing this computation for the purpose of my tax liability. Are we clear? Yes, let's understand this carefully now. Now, what am I? I'm an individual age 45 years. I'm opting out of default tax regime, which means I'm going for old tax regime. Here is where you'll have to be a little careful. Now, when it comes to tax, people, there is certain things to be kept in mind. First, when it comes to tax payable, you need to understand that the question comes and clarifies that you have no other incomes. The fact that you have no other incomes means that when it comes to capital gains, you can adjust a portion of your capital gains against your slab rate incomes. For all the students who have learned from me, we call it very famously Kaju Katli example. Yes, so the Kaju Katli example will be applicable here, and in which case 66,75,000 or 31,90,250 as the case may be will not be liable for taxation to the extent of rupees 2,50,000 rupees. So I'm going to ignore of 66,75,000 may say 2,50,000 rupees. So what I'm going to say, up to 2,50,000 tax is going to become nil in both the scenarios. Is going to become nil in both the scenarios. The remaining income which I have in my hand, which is 64,25,000 on the left side, is going to be taxable for 12.5%, which means the answer becomes 8. Yes, I see the answer as 8,03,125. This is at the rate of 12.5%. I hope everyone clear here. Yes, at the same time, people, you need to understand this carefully. My income is showing 66,75,000, which means I am liable for a surcharge. I am liable for a surcharge. Surcharge becomes applicable to me. So adding another 10% becomes 83,34,37.5. Adding a 4% cess on this, the final answer in my hand is 9187.75 is coming to me, which means 80. Yes, this is what my tax payable is going to be. On the contrary, let's look at the left side. I have 31,90,250. I have 31,90,250 minus 2,50,000 goes away from me, which becomes 29,40,250 multiplied by a tax rate of 20% is going to give me 588050. Yes, because my income is only 31 lakhs, I am not liable for any surcharge in this scenario. I'm not liable for any surcharge in this scenario. So I add another 4% to this example, and therefore the answer becomes 611570. Yes, this is what my income is going to become, which means in this scenario, if you come and ask me, what should Rahul be preferring? The person should be preferring the old rules, which means he should be paying tax only on 61,15,070 rupees. 6,11,570 rupees is what he should be paying his tax. He will not be paying tax on anything else. Yes. So what is the option in this question? The option in this question is going to say, what is his computation of capital gains? My income is remaining at 66,75,000, but my tax payable is going to become 6,11,570. That is what the right example is going to be. Are we clear? Making sense? Yes. A very good question, people, but fairly an easy one. I think you could have made only one mistake, which I can expect, is that when it comes to old rules, you would have not taken it as 100, you might have taken it as 105. Understand, March 2002 still means financial year 1-2, so you should have taken it as 100 and not 105. That is the only mistake which I can expect you to be making. Otherwise, if you have done the format carefully, we showed it at the last day of the exam also, people. If you followed the format, this was the easiest question in the whole format listing. Yes, amazing enough. Clear. We are going on to question number B. Looks like a salary question to me. Yes, it says compute the taxable salary of Mr. Prabhu, assuming that the person is opting out of default tax regime. I'm going for alternate tax regime. Let's look at the question. It says Prabhu is a resident individual, age 45 years, employed with private company as an HR manager on a basic salary of 80,000 per month. he has been given the following information to you: a rent-free accommodation. See, the next thing which I told in focus topics, people, that this time RFA is expected to be tested in exam because it had an amendment in the last year but was never tested. Please expect a question on RFA, and this is where it is. It says an RFA accommodation owned by the company in Mumbai from 1st May 2024. I have it only from May 2024. Sorry. However, he occupied the accommodation only from 1st December 24. This is where the challenge is. So notice carefully, this is not going to be taxable for you from May. It is going to be taxable to you only from December. The company had bought this house in the financial year 23-24 at the cost of 2 crores. It was bought in the last year. I don't care. I am only looking at the current year transaction. Current year this was bought for, current year this was only used from December. So December, January, February, March, 4 months is what I used it. And therefore for the 4 months is what I'm taxable. Because this was owned by the company, I'm taxable at 10% of the salary of the employee. What is salary? We're yet to discuss on this, people. Let's check on my balance items before we decide on what the salary for an RFA is going to be. Yes, next. A mobile phone was given for his personal use on 1st May 2024. The cost of the mobile phone is 90,000, fully exempt. Fully exempt. Reimbursement of telephone expenses, fully exempt of. The company also gives him a telephone allowance of 1,000 per month to cover his mobile phone bills. During the financial year, his aggregate mobile phone bills is 15,000. Here is where they challenged you. Notice, people, when it comes to telephone allowances, income tax is very clearly clarified that telephone allowances are fully taxable. It is only telephone reimbursements that are fully exempt. This means becomes fully taxable. The 15,000 is not even a relevant information. This was a trick for you. Yes, so 1,000 per month is going to become fully taxable as a telephone allowance, but that's just not it. Please notice that because this is an allowance, it has to be added for the purpose of your RFA computation also. Yes, which means for the purpose of RFA computation, it is not going to be 80,000 of basic salary. It is going to be 80,000 plus 1,000 rupees of basic salary. You should have kept that in mind. Next, a company has purchased a car on 1st July 2022 for 10 lakh rupees. This was sold to Prabhu on 1st August 2024 for 2,50,000 rupees. Sale of car rules have been given to you, people. Sale of car rules, what do you remember? Sale of car rules come and say that when it comes to sale of car, it is cost minus 20% depreciation on a WDV basis. Look at when I purchased the car. I purchased the car in 2002. From 2002 to 2003 becomes 1 year. From 2003 to 2004 becomes 1 year, which means there are 2 years in consideration. So I have to depreciate this for 2 years. So it is going to be 10 lakhs minus 20% for 1 year, which is going to become 8 lakhs minus 20% for second year, which is going to be 6.4 lakhs. I sold the car for 2,50,000 rupees only, which means so 6,40,000 minus 2,50,000. Why am I making this mistake? 2,50,000 is going to give me 3,90,000. So here is where I'm going to be taxable for 3,90,000 as a tax payable. And yes, this is an perquisite, therefore it will not be included for my RFA computations. Next, he was allowed to use the video camera and laptop belonging to the company from 1st April 24. The company had purchased these assets for 50,000 and 2 lakh rupees in the current year. People, video camera, laptops, both are electronics. Electronics and laptops are fully exempted from tax. So therefore, I am going to treat the laptop as fully exempted part first. Let's look at the video camera carefully. Video camera may be an electronic, people, but can an electronic be treated as a fully exempt component is what you need to understand. Let's look at what the laws come and say, and then we can take it from there. Yes, let me show you my material quickly and then we understand this carefully. When I go to my notes, DT material intermediate, I have 2025 examination question. We have concept guides opening up here right in your front. Yes, so let's look at my salaries chapter. My salaries chapter comes and clarifies. Where am I? Yes, salaries, and here you go. Yes, it says when it comes to use of mobile assets, only computers and laptops are fully exempt. This is not a computer, neither a laptop. A video camera falls into other assets, and because it falls into other assets, it now becomes fully taxable. Yes, which means for the video camera part of it, I do have to pay taxes. 50,000 rupees is my cost of the asset. I will be liable for a tax at the rate of 10%, which becomes 5,000 rupees. Yes, and this is a perquisite, so will not be included for RFA computations. Clear? Yes. Question says, what is the taxable salary to be computed for you? So let's take this into consideration. First, let me tell you my basic salary. So it is 80,000 into 12 months, which is going to become 9,60,000. So I'm going to be adding 9,60,000 as my basic salary. RFA is where you have to be a little careful, people, because RFA is only going to be happening from 1st December. So let me take the salary of 80,000 plus I should have a salary of 80,000 plus 1,000 per month, right? So I have 1,000 per month for my telephone allowances, which means it becomes 81,000. 81,000 is going to be taken for December, January, February, March, April. No, December, January, February, March, which means for 4 months I'm going to take this number, which is 3,24,000. 10% of this gives me 32,400 rupees. So 32,400 is going to become my RFA computation. Yes, this is one of the reasons why I always tell people to follow the format. I've told you this so many times in classes also, that when it comes to RFA, always keep RFA in the last, because for RFA you need to take into consideration all allowances given in the question. If you have made this mistake of not including the 1,000, you're unfortunately going to lose marks on the RFA piece of the computation part. Yes, next on this side, yes, I'm going to tax the whole telephone allowances. So the telephone allowances of 12,000 rupees is going to become fully taxable here. 3,90,000 has been already computed, 5,000 has been computed. The person is opting out of default tax regime. I'm eligible for 50,000 worth of standard deduction also. Yes, this is what my whole computation of salaries is going to look like. Now, if you personally come and ask me, I would have said question number 3A and 3B is something which you should have skipped off. Yes, 2 fairly seemed manageable and easier. At least on the tedious level also, I think 194C could have been easily answered. Maybe 194Q is where you could have gone wrong. But honestly, if you come and ask me, the kind of opportunities for you to make mistakes in 3A and 3B looks very high. So which means 3 is what I would have said as the last priority in this question paper. Let's look at question number 4 before I change my statement here. Question number 4, last question. It says, Surbi is a resident individual aged 35 years and is a working partner in 2 firms engaged in the retail business of garments. She is a working partner in 2 firms. Okay. She provides the following details of income and losses to you for the current year. Remuneration received as partner from partnership firm A, 9.7 lakhs, deductible while computing income of the firm, fully taxable as PGBP income. Loss from intraday trading in shares of an Indian company listed on recognized stock exchange. No delivery was taken on the shares. This is a speculative loss. This is a speculative loss to be carried forward. I cannot claim any deductions on this. This would get simply carried forward because it would be not. I don't remember having any speculative incomes in this question. Yes, not to my understanding. I don't think we have any speculative incomes, which means this is going to become carried forward for next 4 years. Next, loss from the activity of owning and maintaining horse races. I have loss from the activity of owning and maintaining, one second, I'm sorry. It says income from activity of owning and maintaining horse races. This is going to become taxable under IFOS. Next, long-term gains on sale of property computed as per the provisions of the Act, 9.2 lakhs. Now here is where a challenge is. I don't know whether this is as per old regime or new regime. I do not care as of now. Luckily, if this question does not ask me for tax payable, I will consider this as a CG income and proceed forward. Interest paid on loan taken for repairs of self-occupied property. This is going to be an HP loss. Yes, now I've only paid 1.2 lakhs, which means I'm eligible to claim the full set off of this up to 2 lakhs. Therefore, there is no restriction on this. 1.2 lakhs will be allowed to be set off in this case. Amount received as advance towards sale of a shop which was later forfeited as the buyer could not comply with the conditions. People, forfeiture of advance money becomes IFOS income, fully taxable. That is what the condition is going to be. Yes, so I'm going to keep that into consideration and then move forward. Share of loss from partnership firm, fully ignored. We have discussed this so many times, people, that an income from a partnership firm becomes fully exempt and therefore the loss also becomes fully ignored of. Loss on betting, winnings loss cannot be claimed as a deduction, becomes ignored of. Interest on fixed deposits is 0.8 lakhs. Deposit of 10 lakhs was gifted by her father-in-law. Yes, interest on fixed deposits is 0.8 lakhs. The fixed deposit of 10 lakhs was gifted to her by her father-in-law. People, father-in-law giving a gift to you does not matter. Yes, technically you are not a minor child, so therefore there is no clubbing rules to be applied. It would have only been clubbing rules when you are giving it something to your spouse. A spouse, one second, are you a female? Let me check. Are you? Yes. Okay. I'm so sorry, people. Look at this carefully. Surbi is a female. With Surbi becoming a female, this is now a transfer happening to son's wife. A transfer taking place to son's wife raises alarms, people. You cannot make a transfer to your son's wife. This is now going to become fully clubbed in the hands of the father-in-law. Yes, this is going to become clubbed in the hands of father-in-law. It is not taxable for Surbi. Yes, what is the rules, people? The rules come and say transfer of any income or any asset to your son, or to your spouse or to your son's wife is going to become taxable in the hands of the transferor, which means I will have to tax this in the hands of the father-in-law. This is a very interesting adjustment, people. Yes, you should have made this very carefully. Honestly, yes, it's a small adjustment which you could have made a mistake upon. Nevertheless, Following is the brought forward losses given to you. I have long-term capital loss on sale of unlisted shares of 3.8 lakhs pertaining to 24-25. People, before that, let me check and all what and all losses can I set off in the current year. I have an HP loss in the current year. Now, HP loss can be set off against any incomes for that matter. Yes, so I could rather set it off against PGBP, IFOS, or CG also. Honestly, I could have set off against CG also. I would prefer to set this off against. I have 4 plus 7, 11. 11 plus, yeah, 11 is my PGBP income. And is this person opting out of default tax regime? Compute the gross total income under appropriate heads and the amount of loss that can be carried forward, assuming she is opted out of default tax regime. Yes, she is opted out of default tax regime, which means I will be taxable for differing opinions. 3.8 lakhs. I think you can honestly set it off against any head, people. It doesn't really matter because LTCG also can be taxable at 12.5 or 20%, and the normal income is going to be taxable at 20%. I would prefer to set it off against my PGBP income. So let's assume that the HP is gone against PGBP income, which means the long-term capital gains can be set off against my long-term capital incomes. What is my long-term capital gains in the current year? 9.2 lakhs. Yes, so you can set off the 3.8 lakhs against my 9.2 lakhs to be set off fully allowed as deduction. Fully allowed as deduction. I have a loss from activity of owning and maintaining horse races of 24-25. Do I have an owning and maintaining horse races? Yes. So this also gets fully set off as a deduction. Yes, allowed as a full set off, no problems here. Compute the gross total income, very simple, people. So which means if you have done this clubbing rules carefully, I think you should have been able to answer the whole question. PGBP, IFOS, CG, HP set off, OS is an income, set off and set off would take place into following considerations. Amount of loss that can be carried forward. There is only one loss which you're going to carry forward, which is going to be your speculative loss. Yes, so a speculative loss is going to become carried forward for 4 lakh rupees for a period of 4 years. Will your answer be different in case she does not opt off default tax regime? Will your answer be different? Yes. What is the difference of the answer, people? Is going to be a HP loss. I remember telling you this also, people. When it came to default tax regime, I made you remember this very, very carefully, that when it comes to default tax regime, ICI takes an opinion saying that the HP loss which you have can only be set off against HP income, that too only of the current year. In this case, if I'm going for default tax regime, in that case, I would come and say in default tax regime, this is an ignored money. This is an ignored money. The 1.2 lakhs will not even be allowed as a set off because there is no HP income. You cannot set it off against any other heads also, and you neither can carry forward, which means this will become fully ignored. Other than that, do I see a mistake change in the question? No, I do not see any other changes in the question, which means I will remain the question as it is. Nothing else will change, which means all you have to do is you have to take your old tax regime rules and then you have to add an 1.2 lakhs back. Therefore, you'll get your new tax regime. Straightforward. Yes, there is no need to compute. Good enough. I think this was a manageable question, people. The only mistake you could have made is point number 9. So you could have expected 1 or 2 marks of loss there. But otherwise, yes, an easy question you could have answered off. Last question. State the persons who are not required to pay advance taxes with the provisions. Very, very simple. Who are the persons not required to pay advance tax? A person whose advance tax liability is less than 10,000 rupees, or a person who is a resident senior citizen not having a PGBP income will not be required to pay advance tax. At the same time, you can also write an additional point, people, which comes and says that if you're opting for presumptive taxation of business or profession, 44AD or 44ADA, then you're only required to pay advance tax in the last installment. Everyone else will have to pay the advance tax in all 4 installments. This is a very, very easy question, people. You could have easily scored 4 marks on this. State with appropriate reasons with the following statement of true or false. Anyway, this is an OR question. If I would have answered the previous one, I don't need to answer this. An income tax return can be revised only once. False. False. You can revise income tax returns any number of times until 31st December. No restrictions. Updated return under 139(8)(a) cannot be filed if original return is a loss return. Again, false. Again, false. No. People, even though the return is a loss, you can still file an updated return provided the loss turns into an income. If your loss is going to end up turning into an income, then yes, you are permitted to file an updated return. There would not be any challenges. There would not be any challenges. Perfectly permitted. Yes. So yes, you could have answered point number B also, very easy, but then they're asking for reasons. I would have preferred you to answer advanced tax because there is just 3 adjustments for you to write off. Yes, that is how simple it is. Now, if I have to do a quick review of what looks like I told you, people, I think question number 1 was something manageable, but with a small adjustment on the point number 1. So yes, a 12 out of 15 was easily expected in this. Question number 2 should have been manageable. I don't see a challenge in this question. Bare minimum, you could have easily scored out of 6 mark question, at least a 4 marks. I don't see any problem here, people. Yes. Point number B. Point number 1, yes, I don't know. 194Q could have been a challenge for you, but point number 2 was a very easy thing. You should have easily scored 2 marks in this. So that an additional 2 marks here. 3 is what my personal choice would have been to skip off. So I would have not been giving you a comment on that itself. Point number 4 out of 6 marks. Sorry. The maximum mistake you should have made is point number 9, which is a loss of one or 2 marks, which means 4 marks is easily scorable here. And the theory was barely easy, so which means easy 4 marks here. So if I add this up, I get 4, 4 plus another 4, so which is 8, 8 plus a logical 2 here, so therefore 10. Just to be on a safer side, I take 4 here, so that's 14. And then another 12 marks here, so that's 14 plus 12, which is 26. 26 plus another 12, which is what I took from MCQs. So 26 plus 12 gives me 38. 38 out of 50 is already an amazing mark. With 38, you're already nearing clearing people, which means you just have to score another 2 marks in IDT, or probably another 12 marks for you to get your 50 score off. But if you have done IDT also well, which I heard from people that they have done better, should be able to score you an easy exemption. All in all, if you come and ask me, I would say this paper, again, like I said, does not look easy, people, because there are very, very few hidden adjustments which you should have taken cognizance of. But nevertheless, it was not something which was extremely difficult. Definitely a manageable paper. Compared to the September 2024 paper, which was a nightmare, this is something which I would assume to be a boon of a paper. Yes, which means I hope everyone has done really, really well in this paper. And I'm sure you are going to have a very, very good, very, very, very good examination for your upcoming results. Yes, so wait for your results for the next 1.5 months and see how you've done. If you do have any questions, please drop it in the comments section. And yes, before I close forward, just a small help, if you can just give me a small comment on how you have scored in your MCQs. I do not want any paper evaluation, people. Do not tell me I'm scoring total on this. I do not want to understand that. All I need to know is how much have you scored in MCQs, because yes, if you come and ask me, MCQs had some trick adjustments, but if you can tell me that, Rahul, based on your analysis, I think I've scored all 15 on 15, I would be really, really happy to see your performance in those. Yes, so for the MCQs alone, if you can just score me or drop me a comment, I'll be really happy to read all your comments and give you a response back. Anyone else who has any doubts, any clarifications, my WhatsApp number is there in the description box, so please feel free to reach out to me and ask me any questions for your upcoming Jan exams as well. If you have any challenges, I'm always here to support you off. With this, I would like to sign off for today. Thank you for listening to me for the last 1 hour. I hope this review video was insightful for all of you, and we will soon be looking forward to be meeting you all in CA finals as a qualified chartered accountant. Looking forward to your dreams. Yes, until then, take care. Bye bye.